This is kind of a sequel, in my opinion, to SPLV, which is the one everyone knows. That goes out and looks at the 100 least volatile stocks in the S&P. But one of the wraps on SPLV is that you get overweight sectors that are going to move with interest rates. So if rates go up, it could get hurt, right? Utilities, staples. This tries to answer that objection by having a low vol product that is not rate sensitive. So you can see here, it's a pretty big hit, 166 million, 25 basis points, very cheap. Let's look at the sectors. That's really where the difference is going to be highlighted here. So SPLV versus XRLV. The biggies here are going to be real estate, which we know is rate sensitive. Look how little XRLV has. And then utilities. But also look at financials. Financials actually move up with rates because banks lend money, and you'll see way more weighting in that here. That's also part of that rate-sensitive play. Let's look at the performance between these two in the first half of last year is when rates rose to see if it works. And it does. It definitely did a little better than SPLV, although not a ton. So I think that's something investors will have to weigh. But, Scarlet, I think certainly for investors who like that low vol play but are really worried about the rate component, this is a solution.
All right. Well, joining us right now is Gary Stringer. He's president and CIO of Stringer Asset Management. And Gary, you're an ETF strategist, and one of your firm's holdings is XRLV. Talk to us about how you use this fund. Does it replace a low vol or min vol fund like SPLV or USMV in your portfolio?
It doesn't. We use it as a complement to the other low vol strategies and the more defensive strategies that we're implementing today. So as our broad outlook is constructive but also conservative, we don't think this is an environment where we want to be real speculative one way or the other, overly defensive or overly aggressive. We think the economy and the markets have reached a level of equilibrium where interest rates will stabilize. And equity markets will stabilize as well in terms of total returns going forward. So the way we're using this is to complement some of our other low vol strategies. And you pointed out the heavier weighting to financials, but it's not necessarily the traditional banks that this ETF owns. It owns a lot of insurance companies that fall into that space.
Gotcha.
And these are financial sector companies, but not nearly as interest rate sensitive as the banks might be.
Now, Gary, you are an ETF aficionado. That's all you do is invest in ETFs. So you brought us, or I picked out some of your non-obvious ETF picks. XRLV is one. Another one is IYLD. This is the multi-asset income ETF. People want yield. This is sort of like a choose all the above for yield, right? And talk to me about why you like IYLD.
IYLD is a nice fit for us, again, complementing some of the other things that we do. We consider this as part of one of our more non-traditional ETFs that offset some of the equity sensitivity in our portfolios. So this portfolio gets nice yield to it. It has a yield of around 5%, but it's not necessarily stretching for yield like you might see with a bunch of loaded fixed high yield bonds and those kinds of things in there. It's broadly diversified, and we expect it to generate about 70% of the total return of the equity market with about a third of the risk. So that's a nice defensive component for us in these markets.
There's a theme here about defense and safe plays here. Another holding that intrigued us on that list of unconventional ETF picks is the iShares Medical Devices. It's pretty niche-y and pricey, but it's fairly big, which surprised us, $4.6 billion in assets. How'd you find this one, and what do you think is driving its performance?
Right, so the IHI, the medical devices, is one that we've used off and on over the years as a tactical investment for us. We fundamentally like the U.S. healthcare space, but when you think about broad healthcare, it's made up of a lot of big pharma companies, right? Yeah. And they tend to be very politically sensitive. Yet the medical devices, you see these guys getting dragged out in front of Congress and talking about the prices of drugs. Well, you don't see Medtronic getting dragged in front of Congress talking about the prices of artificial hips and knees, right? So it's the same fundamentals, but much more, we think, less politically sensitive. We actually just backed off that position because it's trading at 44 times next year's earnings. And so we made a nice gain in it, but it's like, how much more is there in the tank in this thing, at least for now? We'll probably be back into it at some point when the price is a little more attractive for us.
Yeah, along the way, you avoid the political headwinds.
And infrastructure, NFRA, that's a flex shares product. Most people would think of the iShares, the Global X. Why this product and why infrastructure? Because it doesn't look like a deal is going to happen anytime soon.
Right, so this is more of a global approach for us. It gives us the opportunity, NFRA is a global ETF, so it's not just the US, and it gives us an opportunity to participate in some of the foreign equity markets that are trading at a reasonable valuation, but it's not very economically sensitive. We're not big fans of the European banking system, for example. I don't know what they're going to do about Italian banks, but this is an ETF that if the global economy is accelerating, and it's all about the pace of growth and the pace of change and the change in that growth, if it's accelerating, this is a strategy to lag because these are very consistent consistent revenue and earnings-oriented companies. But in a choppy environment, when global growth is kind of steady or declining, this will hold up great because it's companies like national railroads, et cetera.